Okay, we're live. Darabit Live, June 15th. I wanted something exciting to say about June 15th, but I don't know anything exciting about June 15th, except today's a great day.
Well, it's been
All
a
right.
pretty exciting evening after the FOMC.
That's true, and we're going to talk about that just shortly here because the markets, as we predicted last week, because we do had all the financial numbers coming out this week in the FOMC, we figured something would shake loose, and it did a little bit. Nothing dramatic, not typical crypto fashion drama, but some people are still coming on board here. I got a little survey. I'm just going to publish it right now, or a little poll, I guess. I just want to know how familiar you guys are with covered calls, and we're going to change up the format just a slight bit. I'll explain that in a second as we wait for some more people to come on board. And we've got lots of good people here. We got Alwyn, and we got Sergio as usual, and an international audience, which is fantastic. Let's see the poll so far. We've got 71% saying yes, they are familiar with covered calls, 28% no. So that's good.
Wait, where do you see the participant list? I don't see that. The attendees. Okay.
That's secret access for me only, Richard.
Yes, I see. John High. What a fantastic name. Gianandrea de Cesare.
It just sounds like
sounds like the son of a king or something.
Yeah.
Sergio High, Alwyn High.
John from Japan, that's great. Fantastic. And we'll get started in just a minute here. And actually, while we're getting ready to start this live broadcast, we were just looking at charts and looking at positions because we've done a fair bit of trading this morning and last night. So we'll get into that. It's exciting stuff. Finally, there's something to talk about, right? It was so boring for so long. So start to get some action, which is great. And hopefully the action will continue. I suspect it will. All right. From Italy, but not a king.
Not yet, anyway. There's always time.
Yes.
Vincent High.
Yeah, because like Italy, it's like San Marino. It just feels like anybody can go there and just set up their own little kingdom, maybe. I don't know. Is that how it works?
I think anyone can do that. You don't have to be prepared to defend it, but
yeah, that's the problem. Yeah. Okay. Well, we might as well get going now. Anybody else can join us later on. They can, of course, see the recording. So today, let me advance the slide here. We're going to be talking about covered calls. Actually, let me just make our images just a little bit smaller there so it doesn't get in the way of the slides. So we're going to do our market analysis. I'll go over some charts, talk about current trades, what we got going on. And I know when we originally were promoting this, we're talking about all the stuff with covered calls. We're going to talk about synthetics and mistakes to avoid and this, that. As usual, we'll talk for hours about this stuff for too long. And it's our sincere intention to have these 30 to 45 minutes in total because I know everyone's got busy days and I want to respect your time. So we're going to try and narrow things down a lot more. And the other thing that was happening before was the beginners were getting lost too quickly. So I'd rather build up a foundation. So I decided to break it up into a series of episodes on covered calls. So next one, we'll talk about covered call campaigns, choosing strike prices. We'll talk about managing and rolling and adjusting covered calls. We'll talk about synthetics. And then we'll talk about the top mistakes to avoid. But today we're just going to talk about what these things are. And they're a great place to start if you're new to trading. And when to sell them, ideally, and then we'll get into our Q&A session. Now, I will apologize. Richard was saying we're having sometimes a little crackly sound when I was raising my voice, and I just forgot because I like to raise my voice. That's my dad instincts coming out, I guess. But I'll try and keep my voice down, and hopefully there won't be any sound quality issues. Richard, do I sound okay? What about you guys listening? Does it sound not
actually
too bad?
It's gone away. Actually, I wonder whether it was a problem with the pre broadcast mode of the software.
Okay, fantastic.
I want to just apologize. Just apologize for whatever I'm about to do or not do. I find that's always good policy with me.
Okay. You can become an honorary Canadian. You're apologizing in advance. Okay. Thanks, John. Thanks, guys, for letting me know that. That sounds okay. All right, let me share my screen right now. I'm going to head over to, let's see here, to my charts. Everybody can see this?
Yeah.
Fantastic. Okay. So I've got, Bitcoin and Ethereum. So they're fairly similar, but we can see what happened last night. We got this big down area down here. We're kind of right in the middle of this next channel. In my personal opinion, I wouldn't be surprised if we went right back up to the top of the channel. Trading is always level to level. Now, I've drawn two lines in the chart. This is not technical analysis 101. This is super basics. I don't want to have lines all over the darn place. But I'll tell you about what we've been doing. And when I go over to Bitcoin, very, very similar, right? Here's that unicorn that I put down there. I mean, way when it was back over here. When it gets down there, you're going to start to see us execute a lot more strategies. But Bitcoin is really coming down to its support level, whereas Ethereum has sort of broken through that area of previous support, which may or may not turn into resistance, but the odds are likely. So what was I doing? So when we go back here, I'll just grab this. And just like I said last time, what I was doing for ages, all during sort of this area here, is I was selling low delta calls. Nothing was going on. Remember, volatility was coming down. I don't want to sell volatility. There was not much to do, right? We're just kind of sitting and waiting. I didn't feel it was going to break out to the upside unless there was some serious news. And I was buying low delta puts. Now, those have all paid off. And most of those low delta calls have all expired worthlessly, or I took them out for next to nothing. And some of those low delta puts are now starting to pay off as we're, moving down. So, but that's not all I've been doing, of course. That's what I was doing. Now, I haven't been doing that since the last 4 or 5 days. Now, what we've been doing, what I've been doing is I've been buying low IV July at the money puts, and I'm selling the weeklies, sometimes the 3 days, against the high IV low delta puts. Now, I believe, so for example, in Ethereum, I think I've got like 1650 is the highest strike. So those are a little bit underwater, by 20 or 30 bucks right now. Not a big deal. Remember, I hedge off with futures. Some of them are 1600, some are a little bit, might be a little bit lower. But I'm really liking this trade because, we're in a kind of a strange environment. We're not really used to this situation in crypto. We're having this low IV. It has creeped up, of course, but that's what I've been doing right now. And and I will mention the puts I'm selling at about 5 to 1 compared to the puts I've been buying. Okay, now that's what I've been doing here, and I'm doing the same strategy in Ethereum and Bitcoin, so there's no point in me putting the same information on both charts because I'm treating them both the same right about now. IVs are fairly similar. That's what I've been doing. Richard, do you want to chat about what your strategies are right now?
Yeah, so I do something different. So I trade systematically in a couple of the books I trade, and I've got a personal playbook. I just wanted to kind of show you guys this because I realized that we have just had a sell-off, and if you were short puts, you might be sort of feeling the pain right now. So let me, how do I do screen shares?
And while you're doing your screen share, I'll remind everyone there's the Deribit link at the top of the chat pinned up there. If you sign up under our umbrella, you get 10% off your trading fees. So go ahead and do that if you don't have a Deribit account.
Okay, so this is my one of my Bitcoin books. Okay, so here I've been short calls and I'm actually short puts. And that's when they were about 10, 15 delta. And they've all kind of just stopped at the money or just out of the money. So that's converted all of that.
What expiry is that, Richard?
This is tomorrow. So it's like I did a Bitcoin did like a Looney Tunes breaking sound at about 25,000, right? So These 2.3 bitcoins of 25,000 puts, they're under a little bit of stress. But actually, this is a systematic book, and actually, I've been selling perpetual futures all the way down, so I haven't actually felt the pain from this. In fact, this has put me in a very nice situation. I think my theta tomorrow is something ridiculous, like about $1,000 or something stupid. Option 16th of the 16th.
Yeah, 1,000 theta. Yeah.
Yeah, so I'm picking up if we don't move very far, I'm picking up $1,000 in the next 20 hours. That's on a $50,000 account. Don't do this at home, kids. This is a test book. It's $50,000, which in the scheme of what I trade is not a lot. And then on the my ETH book is you see us a margin abuse up here. I've got 12 ETH, which is about $20,000 these days. And my initial margin 73%, my maintenance margin about 60. That was up to like 75 this morning. You shouldn't do that.
No, but again, 30% is our golden rule, right?
Yeah. But what I wanted to show you is because you guys might be in a situation where you've been selling, you were short puts, and those puts are now in the money. And if you look at this screen, you can see that 1800, I've got minus one ETH of puts, and at 1750 I've got minus 3 ETH, and at 1700 minus 1, and 1650 minus 1. And what I was doing was systematically just selling an ETH for each sort of drop in the market at about 10, 15, 20 delta. And you can see that I've sold all the way down, and in fact I think all of this is in the money, right? What's ETH at right now?
It's 1635 or something.
Yeah, so okay, so these bottom two are out of the money, but the rest, all these other ones are in the money. But again, I've been sort of automatically gamma hedging, which is selling perpetuals as the market drops. So what I've actually done is turned that moneyness of those options into theta, which is why I'm picking up $600 of theta tonight. And I'm kind of happy-ish with that. I think we've got the. I mean, Asia didn't react too much to the FOMC carnage in the States. Europe doesn't seem to have reacted too much. We might have like the second wave of people who wake up to see their margin call and freak out and trade in the US. But then we're going into a weekend, so I kind of think, how volatile is it going to be? And look at this 1600 put. It's at 68 vol, and this 1550 put is at 91 vol. I mean, I'll sell 60 vol all day long in the current market. I mean, we've been ranging between 35 and 40 vol. So I'm happy to sell that all day long.
Yeah, and it is worth noting too. I felt that even today, even with this big drop, I was still selling some puts and buying, like selling the short day. I was selling the 3 days out, and I bought some more July at the money puts. And I was happy to do so. I thought, I'm hedging it off. I do have the long puts. I was positioned on the downside anyways. I have been for a while, slightly, I shouldn't say positioned, but biased that way. So if it went down, my equity has gone up, since that drop. I generally don't try and predict markets, but I felt we were more likely to go down than up. But I just felt that we weren't in for the proverbial earth-shattering kaboom. We might go down. We might, drop another $100 tomorrow. I don't know, possibly. But I'll hedge that off. But I kind of suspect we might just drift back up or bounce back up to the bottom of that previous range we were in first. Certainly within 2 or 3 days. And as I said, the weekend's coming up. Those, if this thing expires anywhere, where it is now up to, 1660, 1670, anywhere below 1700, I'm collecting all the premium for all of those puts, and I'll just keep selling the short dated. So I've been pretty happy with this. It's not an easy market to trade. We were all sitting on our hands waiting for something to happen. It's not like there's the most obvious trade in the world, and if you didn't take it, you're a dummy. Well, no, I never think that, but it wasn't easy. There was a lot of opinion this week that was coming out about this FOMC. People thought that crypto was going to go way up. Maybe they were right. I don't know. So you have to be prepared for anything, I think, is sort of what I'm trying to drive at here.
So I made one of my famous calls yesterday in the little funds I trade, where I said this FOMC is going to be nothing. They're going to announce no rate cut or rate hikes, and nothing's going to happen.
Yeah.
Famous last words, right? So whatever I say, do the opposite. So I said, yeah, let's just sell 10, 20 delta calls or puts, because the vol is high. There was a 20 delta skew, a 20 vol skew on it. And I thought, let's just sell that. Mm-hmm. And if we're wrong, we're wrong, because we'll just hedge down. And lo and behold, ETH dropped, was it 6.5%, and Bitcoin dropped 3.5%. Fairly, in the scheme of things, fairly big gaps. And there were a couple of gaps in that 6% as well. But even then, even though I wasn't able to perfectly hedge it, I hedged it well enough that I didn't actually lose any money, even after calling it wrong. And that's kind of what I love about options. You can be wrong and still be right.
Yeah. Okay. All right. So if anybody has any questions regarding our trades, put them in the Q&A. We'll ask them at the end at the end of the episode here. We'll get to all those questions. Nothing crazy going on. I think we're keeping things fairly simple, fairly straightforward. And with that said, Richard, was there anything else you wanted to share about any strategies or positions you have on right now?
No, I think. No, I'll tell you what I'm doing. I'm just I trade a systematic strategy, which is kind of a secret, so I won't trade that. But I also trade a bit of prop around it. So I reserve about 20% of the book for prop trades. And right now, I'm happy to sell puts and buy calls. I'm happy to buy the skew. Early this morning, when I woke up at about 6 a.m. today, the skew was at minus 40%. I mean, if only I've just literally landed, flown to Portugal and landed last night at midnight. So my computer was out of batteries and I couldn't get on the Wi-Fi and I couldn't trade. But I saw on my phone the skew was minus 40. I thought I've just got to go and buy that. Right? There's no way that's going to be allowed to persist. And by the time I got my computer connected, we were down to minus 20 skew. But I'm still happy to buy the minus 20 skew. Mm-hmm. And just for the uninitiated, what that means is that if you look down for the puts that are trading at 10 delta, then you'll find that the implied volatility there is 20% higher than the implied volatility of the 10 delta puts. So that seems to me like an imbalance, right? That can't persist. It certainly can't persist beyond expiry, because at expiry the price the intrinsic price is zero. So that seems to me to be like good value in the puts at the moment.
Yeah, and we can actually look at that. So what I'll do is I'll jump into the covered calls, but then at the end I'll go in and I'll make a trade. I've got a test account open with Deribit, but I've never used that. But I can also make a live trade as well. But when we're in there on the options chain, we can always jump around and talk about the IV and point out these things that we're talking about here. So let's carry on, and let me just make you a little bit smaller there. Wish I could make me big and you small. Webinar Jam needs to fix that feature. All right, so let's get into covered calls. Again, I want to just sort of start with the basics. I know we've got 30% don't know what they are. This is a fantastic place to start if you're new to options, because it's safer, easy to understand, and a good place to start. So the next 4 episodes are going to be wonderful for you. So what is a covered call? Well, it's very, very simply, you own an underlying asset. Doesn't matter whether it's Bitcoin or Ethereum or Google shares or oil futures, doesn't matter. You own something and you sell a call option against it. To be clear, the same product. So if I had Google and I'm selling S&P 500 calls, that's not a covered call. Okay, it's the same product. That's all that is. So what happens is you collect a credit because you're selling a call. So you're making the asset you own kind of pay you some rent. If it's just sitting there, you may as well make it pay you some rent. Okay, you're reducing your cost basis, so it's a partial downside hedge. Okay, and I'll show you all this graphically in a second. I'll show you some risk reward charts for people who are more visual oriented. And theoretically, if you held something long enough, you could reduce your cost basis to zero. I mean, if you held on to a stock or a crypto or something and you just sell, what we call a covered call campaign, which we'll cover in the next call, you could get your cost basis down to very, very little or maybe zero. You're basically owning the underlying asset for free. It really depends on the implied volatility and how long you've had it for. And that's really what a covered call campaign does. You just run it forever until your bias changes. And that we're going to talk about changing your bias and mistakes to avoid, because if your bias changes, you think the thing's going to plummet, you're better off just to get rid of the darn thing and not hold on to it. And the other good thing about covered calls is that you can manage them, adjust them, depending on what's going on in the market, depending if there's news coming out, FOMC, things like that, or you think there might be a big surge. You can take these trades off and on. You can push them further out, farther in. You have complete control. So they're a really interesting tool, a really interesting strategy that can really squeeze more revenue out of your trading. And of course, on Deribit, you own the underlying asset. So if I'm trading Ethereum options, and I've got examples for Ethereum coming up right now, it means I've got Ethereum in my account. So I've already got it in my account. You're not trading against USDC, for example. Okay. So what's the drawback? Well, you're going to limit your upside potential during the life of that option. While you've got the option until expiry, that you're going to limit the upside potential. I'll show you that. And I put this still susceptible to downside risk because some people kind of think it makes them a bit more bulletproof, but it doesn't. It does give you some downside risk, but if the thing plummets, you're still going to get hammered because you own the underlying it, and I'll show you that. So
we're saying here, just on that subject. So I'm very much, I price my books in BTC and in dollars because I trade to make a living, and the world tends to accept dollars for goods and services and housing costs and so on. Whereas Shane tends to trade to accumulate BTC and ETH. So if you're selling covered calls against naked ETH, for example, you're holding the ETH token, selling ETH covered calls, you're accumulating more ETH. And for you, downside risk doesn't kind of matter because you're happy to hold ETH. Whereas for me, holding ETH represents a 1 delta risk. So for me, if I'm selling covered calls against ETH, then it's like for me, like holding a risky stock that I'm selling covered calls against, and I want to get paid to own it. I just wanted to
fair enough.
That.
Fair enough. All right, so this is a very typical risk reward profile. Now ignore everything here. Ignore everything except this blue line. This blue line is if you owned an underlying. Let's say it's ETH. Could be Google, could be anything, doesn't matter. And you bought it right here where it says underlying acquisition price. Cool. If the price of ETH goes up, well, you know what? Happy days, you make money. If the price goes down, right, you're losing money, right? It's that simple. And when we then introduce a covered call, what we're doing is we're selling a call. So let's say we sell it at this strike price here, and we're collecting a premium. That's what this is, the premium. And remember, whenever we sell a premium, that's the maximum we can make. We can never make more than what we collect premium at the beginning. So that's our max profit. We cap out our profit. But we give ourselves a bit of this downside cushion. So we bought it here, but our break even is further down the line, further down the price line, right?
Shane,
give ourselves some wiggle room.
I can't see your pointer, dude.
Oh my gosh, my pointer's not showing up. I'm so sorry.
No, you might want to draw on the screen.
I'm going to, yeah. I'll do that right now. So this is where we purchased the underlying asset, right? So here, let me make this a bit better visibility. So this is the strike price. This blue line, or this is the price of the underlying asset, the blue line. If it goes up, you're making money. If it goes down, you're losing money. Now, if we sell a call option out here at the strike price, we collect this premium. That's what this distance is here. That's cash money in our pocket. That's a dollar sign, by the way. That's a dollar sign. And what we've done is the price we bought the asset at, we move our break even a little bit lower down the price line. So we give ourselves a bit more cushion, a bit more wiggle room. And this is all a covered call is. Let me clear that off and go to the next slide. Interestingly, the risk profile is the exact same as a short put. It's the exact same. If I sell a put right now, I'm collecting premium, right? Just like I did with selling a call. We're collecting this. That's the most we're ever going to make. Maximum we're going to make is that premium. And we're giving ourselves a bit of a cushion in between the strike price and our break-even price. So we collected that money. So it can go down a little ways before we start to lose money. And of course, if it starts to really go down, we're going to lose. That's why we don't recommend selling puts naked. Now, you can only lose as far as zero. The asset can only go as low as zero, but it's going to hurt a lot. It's not infinite if you sell a call.
Can I cut in there and just reiterate this? So I think this is really important because if you're selling covered calls against holding ETH, so you own the ETH token and you sell a call against it, that is exactly the same as if you owned the cash, the dollars, and sold a put, in the money put, the exact same risk profile. And so when for those of you who are not hugely experienced in options, you end up not caring whether you're holding puts or calls, because you can always convert one into the other. You either by holding different underlying, or by selling or buying perpetual futures or dated futures. I just wanted to add that as a thing we can discuss in a future episode.
Thank you. Yeah, and I think that just the point here is I just want to say, hey, you're going to find as you learn more about options, actual strategies share the same risk reward profiles, or we're very, very similar. And it's quite interesting how it's just a few little pieces, but just the way you configure them together. And the reason why it's called a covered call is because if I went out and I sold a call, I didn't own the underlying, I just sold a call, and I happened to do it at this strike price. Well, I'm going to collect this premium, right? When we're selling, we collect the premium front. That's the most we can make. It gives me some cushion. If the price goes up, I'll keep making money until I hit this break-even spot, and then I can lose infinitely. Of course, price of something is never going to go to infinity, certainly not before the expiry date, but it can hurt a lot, and that's uncovered. But because I own the underlying asset, let me clear this off. Because I own the underlying asset, for every dollar that the price, so let's say the price goes against us and it goes above our strike price. Well, for every dollar it goes above the strike price, my underlying asset is going to be making $1 for every dollar the short call loses. So I hope that is relatively straightforward. I'm going to get into a practical example here. And ETH, I made up these slides just yesterday or the day before, and I've got some screenshots too. So the market's moved a little bit, but we'll do some live trading in a second. So this is a naked long ETH. I just bought ETH. Let's say I bought it at 1,700 the other day, which it's actually realistic. And what's going to happen here? Well, the second I buy this darn thing here at 1,700, the price is going to go up or down. It's a 50-50 chance. I don't know which way it's going to go. I had my inclinations, but nobody really knows, right? So it's a 50-50 chance. And what's my risk? Well, the risk is my cost base. It's $1,700 because this thing could go to zero. I could lose $1,700. That's my entire risk with this position by owning ETH. Now, if I owned ETH, whether I bought it yesterday or I've owned it for 6 years, doesn't matter. I can make it pay the rent. And what we could do is, and so what I wanted to say is and this is obvious that our profit is unlimited because it can go to the moon, right? It can go to $3,000, 5,000, wherever, right?
So they tell us, yeah.
To the moon?
Well, they keep telling me that ETH's going to the moon.
Yeah, you keep telling yourself that. It's going to go to the moon. Please go to the moon. Yeah. So what I can do is, and I took the screenshot yesterday, and let's say I wanted to sell this is Richard's heads in the way I think there, but it's a 1,900 call. And don't worry, I'll show you this on live trading. But I'm selling a 30 delta call. Ends up being 1,900 as a strike price. And you can see there I zoomed in. It's about $42 I'd collect for that, okay? So I collect $42, all right? I sell this call right over here at $1,900. Now, this is a July call. Okay, it's got 43 days to expiration. That was yesterday when I bought it. And it's a 30 delta, minus 0.3 delta. Okay, so let me clear this off. Can you see my whole screen, Richard?
Yeah, apart from the logo in the bottom right-hand corner, yeah. Okay,
good. I think it was just the whiteboard was cutting some things off. So we go ahead and we decide to sell this 43 DTA days to expiry, 0.3 delta call at a strike price of $1,900. And for doing that, we're given $42, right? We sold it for $42. Well, it changes things now. Now our max profit is 242. It goes from unlimited to 242 because the price of ETH, and I'll put my thing back on, if it goes from here, from 1,700 all the way to 1,900, well, we're going to make $200, aren't we? Plus the $42 we collected in premium. Okay, so $242 is our max profit we could make here during the life of this option for the next 43 days if we held it right to expiry. Okay, and we can see we've reduced our cost here just a little bit from 1,700 down to 16,958. So we reduced our cost by about $42. Okay, and that increases our odds of profiting, and it generates a little bit of income, and it's going to potentially increase our ROI. So when we look at these numbers, if we think about having one ETH, that's a delta, and if we sell a 30 delta call, a negative 0.3 delta, it's negative because it's a short bias. The delta is now 0.7, so our delta has been reduced. That gives us a little bit of a hedge, right? A little bit of a downside hedge. We're reducing our risk, our downside risk, by $42. Okay. All right. What else we got here? Covered calls are pretty cool because they're profitable in a few scenarios. Now the price, if I go back up here, the price can go up to $1,900. And that's actually our preferred situation. That's our max profit because we're going to make $200 on the underlying and we're going to collect all the premium. So if it goes up to 1,900 on the day of expiry and that option expires worthless, we keep all $42. Well, that's our ideal situation. So it can go up. It can go up as far as our strike price, and we're going to be profitable. Okay.
I just want to say something here. Dude, sorry to cut it in. If you just go back to the diagram, just out of interest, people might be interested to know that was that 30th of June or was that a 43 day, right? So a month and a half.
July 28th.
Yeah, okay, July. Okay, so for that option, you're receiving $42 against an asset worth $1,700, and 42 is roughly 2.5% of 1,700. So you're actually receiving. You could think of it as receiving 2.5% interest for holding that position for 43 days, which means you could do that across a year, sort of 10 times, maybe 9 times, pick up. Theoretically 25% interest on your asset, which is a pretty good rate of return.
And if you can maybe avoid, some people might avoid selling them in low IV environments and sell them a bit more aggressively in higher IV environments, you can tweak that. Then you get into timing and you can be, and actually, this is very interesting because we have a covered call course coming out at the Academy, and there's a few ways you can really wring more profits out of covered calls, which we won't get into in this call. We're just trying to set the foundation here. But covered calls, even though they're one of the most common used strategies out there, I think they're often misused just because people just sell a bit and not really kind of crunching the numbers and looking at it. So we'll get into that in later episodes. Richard, was there anything else you wanted to say about this?
No, that's all. Yeah.
Okay. So anyways, the price can go sideways, right? The price can just bounce around here between 1,700, 1,800, whatever. It can just fart around sideways, and we're still going to make money because we're collecting that premium. And it can go down. It can go down a little bit as low as a break even. Now, in this case, we've only got $42 of break even. It doesn't give us a lot of downside. We only sold one call, and we only had one ETH in this example, but it does give us a little bit of wiggle room. But if we keep doing this, let's say we do it every 30 days or every 60 days or 45 days, whatever, that cost basis gets reduced and reduced and reduced and reduced. And next thing you know, you're 2 years down the road, and you've significantly reduced your cost basis, maybe by 20% or something. So it's definitely worthwhile to look at. So who uses covered calls or when to use them? I mean, we can see here if you're neutral to slightly bullish, okay, that max profit, as we showed, is when that underlying price goes up to the short price at expiry, but not above it. I mean, is that ever going to happen? Maybe one time out of 50, it'll maybe happen. So, we're not counting on that. We can never be that precise, but that's the real sweet spot. And ideally, and I think this generally applies to any time you're selling, is you want to sell in a high NV environment when you can. When not to use them? Well, if you're super bullish, if you think ETH is going to the moon and it's going to be, 2,500, in the next 30 days, well, I wouldn't sell a covered call. No, let's ride that up, because you're going to be limiting yourself. And of course, when if we want to talk about stocks and things, then you get, then there'll be, you'll get assigned and all those things. But we're just talking about crypto for now, and basically we're just going to lose out as soon as it goes above our strike price. We're going to start losing dollar for dollar because these are cash settled. So we want to sell. We want to use them when we're neutralists, not when we're super bullish, and not when we're super bearish either. Because if we think this thing's going to plummet, why hold on to the underlying asset? If you wanted to hedge it off, fully hedge it off by buying puts or selling futures or something, fine, go ahead. But I'd rather sell the asset in that case is buy it back cheaper. I could still speculate on the downside movement by selling futures or buying puts, but not holding the underlying asset. And ideally, just the opposite. You don't want to use it in a low IV environment when you can. But hey, a low IV environment can persist for months or years. I mean, we don't know. Maybe this is the new normal for crypto. Maybe we're going to be bouncing around in a 8 to 10% IV range for the next 6 months. I don't know. So we might as well make some money at it right now, but to make sure we're always guarded. Was there something you wanted to say there, Richard?
Yeah, just on that actually, because we've been moaning about this low implied vol environment, and everyone in the market has for the last 2 months, because we got to a low of about 35% at the money vol on Bitcoin, I think, which does make it quite hard to make money for anyone, frankly. But today, the at the money vols are about 42%, which doesn't sound high, but actually that's 7 vols higher than 35 vols, which means that it's actually 20% higher on a percentage basis. So we've, that's not a bad move. That's half of the of what Deribit takes into account on its vol move, on its margin calculations. It's quite a big move we've seen, right? So any short options books over the past sort of few weeks have had to work pretty hard to stay break even, because it's quite a relatively big move. And I think that's going to continue. I think we're going to see a bit more vol coming in now, which is good for all of us.
Yeah, and I'll go there in a second, but if we keep dropping, if we take some big drops, we're going to see vols increase and present some more opportunities for us. And that's kind of what I'm waiting in the wings for, and then we can really start to do some interesting strategies. But all right, so who uses covered calls? Well, I mean, everyone. It doesn't matter if you've got a little tiny book or you've got $1 million book. It doesn't matter. Anyone can use covered calls. I think it's especially good for if you do have a small book, because it's a safer strategy. You're covered. If the worst case scenario happens, well, you made a little bit of money. The underlying, got taken away, whatever. But you have a not limited risk, because it can still go to zero. The asset can still go down to zero, and you can lose your entire initial investment if Ethereum went to zero. But it's a nice, safer approach to start. Retail, institutional, hedge funds, everyone uses them. Let me just go back here for a sec. I'm going to share my screen.
I was going to just mention about you said don't use covered calls if you think you're really bullish. Actually, I would say that you probably should for different reasons than this call, but because of the way that the implied vols tend to be much higher, far out of the money, you probably also actually should sell covered calls even if you are bullish, but just sell them further up and then get ready to roll them.
And that's, I think, a particular strategy that maybe we can tack that on at the end, because it's one of the top mistakes I say people make. But you're right, there is an exception. There's always sort of a give me and a gotcha when it comes to options with two sides. So, all right. So I'm going to do two things here. I'm going to try this test net out here. Let me make our pictures a little smaller there. I'm going to try this thing. So you can see I went over to test.deribit.com here. And they said you can set up this practice account to do different things. I was playing around with some things in here. Oh, and so you can see it's depopulating. See, it depopulates and then it repopulates. And a few minutes later, it's like all fills up again, right? Because it's just a test account, right? So I was going to come in here and you can see there's a 10 fictional Bitcoin in the account, and I was going to make a trade against it, but I can try.
You can always place the order. As soon as they come back in, you'll get filled, right?
Well, look, so you can see right here, folks, this is the 26,000 strike. This is for July 28th, 26,000 strike is a 0.42 delta. So if I have 10 Bitcoin in there, I could go to the order book here, and you can see this is a test account. So that's why the order book's not full. I could sell up to 10 of these, and it would be a covered call, right? I could sell 10 of these darn things. Let's just see what happens if I put an order in at just above the market if it shows up, and I'll put it in for one Bitcoin. And I'm going to sell, because remember, we're selling the call, right? So create a sell order. Showed up. So you can see me on the offer there, offering my one Bitcoin, and it's really close to the mark price. That's sort of the fair market value price. But if I want to get this right now, I can just click on this 0.42, and you can see it loads it up here, and I could just sell. Boom, there we go, got one. So let's see what happens now. Will it show up in a position? There it is. All right. There, we can see my Bitcoin, 28 July, 26,000 call. I'm short, so I got the little minus in front of it. It shows me the average price I paid for it. That's 0.0420 Bitcoins, right? The current price is that. And my ROI, it's minus 0.7% because I had to cross the spread in order to get that. And that's just as simple as it gets. Remember, I own the underlying asset. Now I could do this. I could sell 9 more of these. If I sold 10 more of these and I had 11 contracts short with 10 Bitcoin, well, one of those contracts would be uncovered now, right? So let's say Bitcoin blows up, and goes up above 26,000. That one short contract will be problematic for me, okay? And I'll have to roll it or work it or close it or whatever I'm going to do with it. So I hope that's clear on covered calls. Very simple strategy. You can see my and just so you know, if you're trading in Deribit, you can see your order here. It's got an X next to it, so you can click on that X and it will cancel your order right away. Anything else you want to add on this demo, Richard?
I was just actually observing while you were saying that covered call you were selling was priced at 0.042 ish.
Yeah, 0.04.
So actually, and you're getting paid in Bitcoin. So actually, if you were to sell 10 of them, you get paid 0.42 Bitcoins. So if you sold 11, you'd actually only be short half a Bitcoin, because you'd have been paid 0.42.
Yeah, that's a really good point. So, and my mind is thinking like stocks, right? Where everything's a nice even number, but we're dealing in different currencies. So yeah,
because you're effectively getting paid. It's like you're selling calls on Microsoft stock, and they're paying you in Microsoft stock.
Yes, exactly. Yes. And you can see, look, all the data just disappeared again. It'll depopulate again. It'll come back and go forward. But anyways, I'd suggest if you want to fool around and do some testing, if you haven't traded live yet, open your test.deribit.com account. You can go there and practice and see how the interface works and see your position.
I'd say the opposite, Shane. I'd say put $1,000 into the account and try it with $1,000 and just treat it as learning capital. Because you'll never get the same feeling like trading paper money. Because it's like playing poker for matchsticks. It doesn't feel as exciting as for money.
Yeah, I think that we've both often said that you just got to start. But I think when I would recommend people hit buttons first, was just so they know what buttons to hit the first time, so they're buying instead of selling, and just little things like just being familiar with the interface, I think. But yes, there's nothing like hitting the button and seeing the numbers change in front of you, because all the theory, it's like, what's happening? You can see your delta change, you can see your theta, how much you're earning, and it's really cool to watch all those metrics in real time. And like Rich, like you said, you don't have to rob a bank and load that into Deribit. You can just put a little bit in there, get started, see those numbers change. And if you're following us, we're always recommending doing things limited risk, and not blowing up your account. Capital preservation. That's the name of the game from our side.
Dude, we're at 45 minutes. So we should probably go into questions.
Okay. Let me just.
It's so easy just to love the sound of your own voice, right?
Well, I actually like the sound of your voice too, to be honest. And just before we get started on questions, we're still doing this 14 days for $7. Pop on over. We've got the link here. I'll just put it into the chat there. Try it out. You can follow us on our Telegram channel. You can ask us questions. We're there. Obviously, we're not sitting there all day waiting for people to ask us questions, but we'll come in there once or twice a day, answer questions, and you'll also see our trades in real time. So let's move on to the Q&A. And I put this link into the chat just in case anybody wants to see it. Okay, let me turn this off and let's go to the Q&A. What do we got here?
From the bottom up. Roberto came in with how is market liquidity impacted by market trends? So I assume you mean there's liquidity of options and there's liquidity of perps and spot, right? But Frank, the long story short is when Bitcoin's going up and when all the taxi drivers are asking you whether they should get into Bitcoin, then there's loads of liquidity in the market because everyone's a superstar and everyone thinks they're a market maker. And so everyone brings liquidity to all the markets. And then, we get reality strikes and Luna and Terra and FTX all blow up and hedge funds go bust and people who thought they were clever aren't proven to be. And so all that liquidity vanishes. So the books do get thinner. But the institutions who know what they're doing, and in that I'll include the market makers who supply liquidity to Deribit, they know what they're doing. And so they stay there through thick and thin. So you don't really notice at our level. If you're trading in like $200 million size, you may notice, but you and me, we're never going to see the difference. I don't think even the size of gaps in the perps market doesn't really change. If the market's going to gap, it's going to gap, no matter how many people are in it. So, yeah.
Next question here is from Darren, and he says, "Do you use automated alerts for significant skew shifts?" That's kind of an interesting question.
So I actually for the funds I trade, I use a company called Immersive Finance, and we'll do a piece with them. Hopefully, we'll invite them on the show one day. So they provide analytics to institutions, and I happen to know the CEO, Will McGee. I worked for him actually at Citi many years ago. And he has produced institutional grade analytics for crypto options. Now they are geared towards institutions, and I am one. Well, I work in one. So, but you could actually write your own little Python script pretty simply, just to query the API of Deribit and pull off the implied volatilities, because they come through in the numbers from the API. Everything you see on the screen in Deribit comes off the API. So we're reading, implied vol numbers off the screen. So can you. So you can just look down, find the volatility. So if you want to know the 10 delta skew, you can say, well, find the puts at 10 delta. What's the implied volatility? Find the calls at 10 delta. What's the implied volatility? What's the difference? Well, that difference is a skew. Right? So you can build an alert bot pretty simply for yourself. I actually have a thing in Telegram. I write in my special channel. I write /surface ETH, and it gives me a vol surface for ETH, and I can go and trade it.
Oh, sorry, I just woke up.
Yeah,
all right.
Sorry, dude.
Yeah. Well, we talk about programming. I instantly fall asleep. So. Next lesson, kids, we're going to do some Python programming. fun. But the thing
people
is,
do that.
Richard
do
actually
live
thinks
programming
it's fun.
sessions. Yeah. I used to when I was younger.
All right.
Def, just wondering about all the details in using perpetuals to hedge. Do you take account of the funding rate? This is really fascinating because I've just been doing some work on this, which is a cue for you all to fall asleep, right? Because if it's really fascinating for me, it's going to be really boring for you. So I used to worry that if I was going short perps, that if we gap down, I was going to pay funding and pay loads of it. And I thought I'd prefer to be short futures. Short futures to pick up the funding and then long perps in down moves. But then I looked at the actual data that comes off Deribit, and it turns out that actually almost always you want to be short perps and long futures because the perps almost always pay more carry than the futures do. So for my money, a good trade is to buy a motherload of 1 year futures and just sell perps in the same delta and then just go and hold. That on average will pay you. So I mean, you'll get drawdowns and you'll get little blips, but on average that'll pay you much nicely. I think you get about, I don't know, at the moment about 8% for being short the perp on average per year, maybe more.
There you go.
So yeah,
your tip.
So these days I don't worry about it. And in fact every day I go through and look at my delta at each strike, my net delta at each strike, taking into account futures, dated futures and options. And if I'm sure any net delta, I will then actually through paradigm I'll cross the perps versus the futures to get flat delta in futures and options and net short perpetuals.
Now, if that hasn't confused the new people, I don't know what will. But fantastic. No, and you're right. It is fascinating stuff, and as you get deeper into this, it does become important.
Yeah.
And I think that you lost sleep about it. You used to worry about it, and that's why way back then I was like, screw it, I'm just going to use the monthlies. I'm not going to use perpetuals.
Mm.
But once you actually look at it, maybe that's not the best way to go.
If you need to hedge short calls, by all means buy the monthlies. If you need to hedge short puts, sell the futures. Sell the perps. Yeah.
Next question from Sid. When do you sell in the money versus out of the money calls? That's a good question. We're actually going to cover that in an upcoming episode as we continue on with this covered call material. I've seen people sell in the money calls. Yep, as a hedge for possible downside. Yeah, you can sell that anywhere you want. How good of a strategy is covered call during bull markets? Do you still employ covered call strategy when the put skew is higher? Do you sell more calls in such cases?
Oh wow, that's he's cheating. There's 5 questions there.
Yeah,
nice one, Sid. Okay, great content. Well, let's tackle them one by one, right? When do you sell in the money versus out the money call? Well, if you think the market's going to go down and you still want to pick up premium and you still own the underlying and you're determined not to sell it, then you may as well sell an in the money call. You can also sell in the money calls, long dated in the money calls instead of actually owning the underlying, which is we'll cover in a later lesson on leverage covered calls. So I'll leave that there. If you're selling in the money calls as a hedge for possible downside, so if you sell in the money calls while you're long the underlying, what you're actually being is long the cash and selling puts. And so if you think it's a downside risk, selling puts doesn't sound like a very clever idea. So actually that's not a great hedge out of interest. And again, we've got lessons on what could be good hedges. But it's a common sort of idea. Yeah, I'm a bit worried about the market. Maybe it's going to go down 5%, no more. So I'll sell in the money 5% in the money call. There's better ways to achieve that. How good of a strategy covered calls from the bull market in 2001? So in 2021, just selling covered calls and hoping for the best would have been a really bad idea. You'd have missed a load of upside. But selling, say, 10 or 15 delta covered calls and in 1 week or 1 day, and then rolling them when you had to, continuously rolling them up when you had to, that actually would have been quite a good trade, because as the vol increased, in that market, you win on two counts. The vol was higher for long dated contracts, and it was higher in the wings. So because the steep smile of Bitcoin and ETH. So rolling, so you sell your covered call, let's say 10, 15 delta, wait for it to get at the money. So now it's got more less implied vol in it. It's got more premium, but less implied vol. And then you can roll it out to a later higher strike by buying it back and reselling it. And then you're just actually injecting more implied vol into it. So you're kind of what you're actually doing is gamma hedging and over hedging on the way up. So you're winning all ways. So you can do it if you know what you're doing. Question 3, do you still employ covered call strategy when the put skew is higher? Yeah, because the put skew is kind of always higher, really, and because of like yesterday, right? So when do you get a 6% up move in a day? Well, in 15 minutes on ETH, kind of once every year, maybe, but you're going to get that every 3 months in ETH at least on the downside. So there's always gap risk on the downside, and so unless the market's in a super bullish mental state, the skew is always going to tend to be close to negative, right? At least in the short end. At the moment, we've got a twist actually in a vol surface, so the skew's negative in the short end up to 2 months, and beyond 3 months it's positive. Make of that what you will. Do you sell more calls in such cases? If you sell more calls, then they're no longer covered calls, because some of them will be covered by the underlying and some won't. So actually, what you're just doing is selling calls and hedging with a partial hedging with the underlying, which is a valid strategy, right? There's no reason not to do that, but you need to understand that if you do go blasting through your strike, you are going to start losing money.
Yeah. Next question from Gene. Isn't your P&L function of difference between realized vol and IV for covered calls?
We missed the one from Marvin, but we'll come back to that.
Oh, I thought we did answer that during the call.
Okay. Realized vol and IV for covered calls.
So he says, like the premium you collect should compensate the downside risk up to a certain amount.
So taking that question literally, so what I do, where I continually gamma hedge, then yes, my P&L is kind of a function of IV minus realized. Premium you collect should compensate for the downside. Well, it should, but it's never going to fully compensate. You have to understand that by selling a covered call, you are effectively holding cash and selling an in-the-money put, and so it kind of implies that you're happy to hold the underlying anyway. So this strategy is right for people who are Ethereum or Bitcoin maximalists. I'm not sure whether that's a pejorative term or not, but you believe in the underlying, so you're kind of happy to hold it, but you just want to get paid a bit more to hold it, because why not get paid? If you are concerned about downside risk, then you probably shouldn't be holding the underlying, or you should be doing some more aggressive hedging. But yeah, so I think that's the wrong way to think about it. Think of the covered call premium as interest on your Ethereum or interest on your Bitcoin. Don't think of it as a hedge for downside risk.
Mm-hmm. And I must admit, it is a lot easier to think about this in terms of equities. It's a lot clearer. So KDC says, so if you have one Bitcoin and you sell one call, or does the amount of the call you sell depend on the delta? So when in my example, I was selling like a 30 delta, or no, it was a 42 delta on the test net. The higher the delta, the closer to the actual market price is going to be. So if you're a little bit bullish on something, you might want to sell a 20 delta or a 15 delta. I mean, it really depends on your opinion of where that wiggle room could be. If you're kind of bearish, you might want to sell, as the question came up earlier, maybe sell an at the money or an in the money call it.
But wait a minute. The specific question here, though, is: do you vary the amount of calls you sell? Do you vary the notional value of the call? And the answer is no. Right? Covered call is covered call, so you're selling one for one. That's it.
Yes. Yeah.
Yeah.
On my test account, I just got filled on my my one call. I made 0.005 profit.
That's been really nice in imaginary money land.
Yes. You should see me play Monopoly. Yeah. Yeah, Rafaela, is this call recorded? Yes, indeed it is. It will be on our YouTube channel, and Deribit will be posting it as well on their channel. Darren,
that's the most flattering question we've ever received. Somebody actually cares enough to want to see it again. I'm actually really touched. Thank you.
Oh, no. Well, everybody needs.
Not by you, by Rafaela.
All right. Do you guys prefer trading these inverse option markets, P&L in coin terms, or normal linear P&L in USD? I think you talked about that at the beginning.
Yeah. So this actually really bugged me when I first came across Deribit, because I it's difficult to think about things in terms of dollars and Bitcoin and automatically convert them when you first get to the market. And then actually I found that, having done it for a while, I didn't care, because you just naturally convert between the two. So I actually do trade the P&L in dollar terms on Deribit, even though the instruments are in inverse terms. And that's because whenever I chuck any ETH or Bitcoin in a Deribit account, the first thing I do is sell perpetuals to the same value. So I turn it instantly into synthetic cash. And not only is it synthetic cash, it's synthetic cash that's paying the interest at quite a good clip. So actually, if you've got spare dollars, there's actually a fairly good argument that you should just convert them into ETH and chuck them in a Deribit account and sell perps on them. You're going to get a bit more interest than putting it in a bank. This isn't investment advice, by the way. So actually, the short answer is now I don't care, because I mentally convert it anyway, and I just use computers to do the hedging for me. But yeah, if you're doing it manually and you're thinking in terms of dollars, and particularly if you're doing the usual thing of selling call spreads and put spreads and hoping it doesn't get in the money, and running it if it does, then it's much easier to think in terms of dollar terms. But I think I heard a rumor that Deribit are going to bring out the linear
Yes.
at some point.
Yeah.
So,
yeah. Last week, I think they sent out a notification, or a few days ago. Yeah. Okay. Next question from John. This is actually a good question, and you're right. So even though it's covered calls, you have less Bitcoin once it goes above the strike, because yes, Shane said he denominate in BTC. So does he hedge with long futures? I don't. Well, no, I do. So I think I never just have a covered call position.
Can I just say, John Smith, welcome to the rabbit hole, because this just gets deeper and deeper, right?
So the way I view things is the way I've always traded for 20 years. If I'm going to sell a covered, I'm selling a covered call. I'm not going to monkey with these differences and get all technical like Richard will. It's my covered call, and here's how I'm going to manage it. But it's never that simple for me, because I've usually got 18 other things going on, and I'm always hedging some risk off. I'm not hedging like Richard does every 2 minutes. But I will hedge some risk off. But no, I treat a position, if I've got a butterfly, if I've got whatever, I treat that as a position, kind of like I would with equities or anything else. I'm not taking into account those unique differences in the crypto world. Maybe I should.
But the long story short is, yes, you will have fewer Bitcoins if you get in the money. And so if you want to keep your Bitcoins constant, then obviously my advice to you would be sell your covered call fairly far out of the money at low delta. And if it gets close to being at the money, then roll it to another higher strike at a later date. And eventually it'll come right. And so you may end up for six months not actually achieving any interest payments on your Bitcoins, but who cares when your Bitcoins just doubled, right? So that's the way I'd see it. So you can't just, if you want to keep your Bitcoins constant, you can't fire and forget. You can never fire and forget with options anyway, right? You can. What I can tell you is it's quite safe if you trade sensibly to look at your options book once a day. That's a fairly safe cycle. Once a week's kind of probably okay if you're long dated. Any less than that, you should be looking.
Mm-hmm. Def has a few questions here. He said, Deribit being a centralized entity, how big or small is the risk of having the account locked or frozen, etc.? I can't comment on that, except Deribit is sort of the...
I've been using Deribit now since 2021.
They're the big guy on the block, yeah.
Yeah, they've got a reputation to preserve. It started by professional guys who worked in the traditional markets. They've got their own. They've got a living to make, but they've also got their own personal reputation, right? and no one wants to lose that if they're proper financial markets people. It's only these young sort of scammy kids that come along and start exchanges based on lies.
Those darn kids.
Yeah, we've got away with it too. But it is though, right? Because there's a if you get an exchange that's started by ex like city guys, they've got a code of honor. It's ingrained in you in the business. But yeah, I think Deribit's pretty safe. I think I'm pretty sure that the guys who run Deribit, if they had a financial problem or had a regulator problem, they'd come out and tell us first. They've got too much to lose by not doing it.
All right.
But if you're found to be wash trading or whatever, then or money laundering, then obviously prepare to get banned, right? But yeah, otherwise, no.
So another question from Def is, it seemed to have a little bit of losing us a little bit when we're talking about hedging with perpetual futures versus monthly, probably. That's something I think we're going to have to
separate lesson, right? We'll do that. Yeah. Join the academy, and we'll do a lesson on it.
That'll take a while. So we're almost done here. Should I compare what I earn on the premium?
There was one we missed. It was from Aravind. I haven't forgotten you, Aravind.
Oh, okay.
Isn't it $42 worth of ETH and not $42 itself? This was when you were selling a $42 covered call. No, so what you actually get for that covered call, Aravind, is that when he sold that call, he would have actually received ETH, not dollars. But he would have received the same ETH that you get by spending $42 in the spot market, which is about how many? 0.025 or something, whatever. So you actually receive the ETH, and so that on Deribit, if you receive premium in ETH for your options, then you have to remember that ETH itself has a delta, so its value will increase and decrease as the market goes up and down. If you're a ETH maximalist, you won't care. If you're a dollar maximalist, you will care, and you'll want to hedge with perpetuals accordingly.
Good stuff. Okay, a question from Mike. Should I compare what I earn on the premium with what I could earn lending the underlying, say, through AAVE? It seems option premiums yield is a lot higher.
I don't know what you can earn on Arve these days.
Neither do
I mean, I think the lending rate for USDC is about 8%, is it, for borrowers, and 6% for lenders. I mean, so yeah, sure, you're going to get way more money for covered calls in all markets. There's a reason for that. You've got to come and manage it once a week, and if you want to get risk-free income, then you're going to get what everyone gets. If you're prepared to come and do some work, then by all means you can make 20% a year for like 5 minutes work a day.
There you go. It's the dream. Now, we both have gray hair, and we're both just turned 28. So, come and join us.
Yeah. Oh, hang on. There's another question from Def. This is a great audience. Thanks, guys. How do you see crypto behave if we face a deep recession? Oh, my God. How do I see it behave? It's going to behave the same way it always behaves, right? There's going to be people who know what they're doing, and there's going to be Muppets. And the Muppets are going to pay too much and get scared and over leverage and cause liquidations, and there's going to be massive spikes up and spikes down, and it's all the same. Crypto is a really immature market, and it's full of immature people, and options gives us a chance to scavenge all of the value of that without doing too much work. But I think what he's asking is crypto going to go up or down? Well, first of all, whatever I tell you,
he added a question there, Richard, for you. He said, will it behave like risk assets? Is there a chance it separates? I think that's...
I'm going to be really... Right, so there's two crowds, right? There's one crowd that says Bitcoin exists because there's spare money in the world, and you have spare money because of low interest rates. And therefore, when interest rates become normal again and people have to actually work for a living, which they haven't had to do, by the way, for about 20 years. So probably all of you guys have never actually known what hard work is, because you weren't alive before year 2000, right? Well, you weren't working. Sorry if I insult anybody. But so when that happens, if it happens, then the world is going to be a much harder place, and there's not going to be so much appetite for frivolities like alternative currency systems. So that's one argument. And I can see all the Bitcoin maximalists now seething. Right? So, and on the other side, there's this thing that says Bitcoin is the hedge against government stupidity, and I'm all for sympathizing with the idea that governments are stupid, because they are. Any collection of people is, because their interests aren't aligned with yours, right? So, but actually, what's going to happen? Who the hell knows? These things are driven by necessity at the end of the day. If we are in a stage where we actually need a alternative currency system to, say, the US dollar or the euro, then we are in trouble. The world's in trouble. And that could happen, right? So I mean, for that reason, I do hold some Bitcoin and some gold and some ETH. But do I think that world goes into recession, therefore Bitcoin goes up? I can't see it.
Interesting to see
myself. Yeah, but never do what I say, because I'm like the Jim Cramer of crypto, except that I've got an honest heart. I'm genuinely incompetent. I think my personal view is that Jim Cramer actually tries to flog you crap that hedge funds don't want, but that's
all right, let's not go down that rabbit hole. Hey, just two more questions here. One that came up in the chat, Sylvanius: covered call plus delta hedging, can this mix of strategy yield better returns? That's a good question.
Yes. Yeah, you can. And I was actually helping one of our students with this a few weeks ago, and what happened to him is exactly what happens to them all. So they start with covered calls, and they say, I own X Bitcoin, and I value my Bitcoin, and I'm never going to lose it, so I'm just going to be really careful just selling covered calls 1-to-1. And I say, in that case, you do it, just sell 1/5 per day of your Bitcoin holding. And so if you hold, I don't know, 1 Bitcoin, sell 0.2 of a call each day, and let them rotate, and then put them in again next week. And so you're staggered. So if the market does move, you've got staggered strikes, and it's easier to deal with. And that invariably leads to, this is great, I'm making sort of 5 basis points a day a return. How can I make more? Well, then you could sell calls against your ETH in more than 1-to-1, so it wouldn't be covered calls anymore. But then you may want to reconsider, what you do when you get near the money, or and so on. And so invariably, people say, you know what, I could sell 3 calls for every Bitcoin I own, and that works for a few months. And then what happens is Bitcoin goes on a charge, and they think, well, I better buy a bit of put to hedge. And so I teach them how to do that. And then suddenly, before you know it, it's just like I was when I bought a fast motorbike, and I promised I would never go above 70 miles an hour. I found myself doing 170 miles an hour down the motorway within a week, just because it was fun. And you get into, okay, people are now actually selling volatility and hedging with perps all day long. That's how it kind of starts. Did I answer the question?
Yeah, I think so. I kind of lost me there. I drifted off again when you got into motorcycles. Love it. No, yeah, it can work. Delta hedging with sure. Well, yeah, it's just gonna, yeah, it makes sense. But then we're always huge fans of hedging because it gets us out of trouble, or it minimizes pain, because we're not always going to be right. Yeah. Never going to happen. One last question: do you prefer trading options in ETH over Bitcoin? If so, why? I do them both. Doesn't matter to me. Sometimes one seems more advantageous than the other, but
I trade both religiously, actually. So if in an account worth, say, $1 million, I'll put half in Bitcoin and half in ETH. And the reason is that they normally behave the same, but sometimes they behave a bit different. So it gives you a bit of diversity in your portfolio for those times, which just minimizes the P&L surprises that you might get from time to time. As of yesterday, I wish I hadn't been in ETH. I wish I'd been in Bitcoin only, but give it a week, it'll be the opposite way around.
Yeah, good point.
But yeah, ETH has slightly higher implied vols, slightly higher realized vols in general. There's a bit more beta in it, right? Mm-hmm. Yeah, I mean, to me, these markets are all just deep seas full of fish that I can't see. So I couldn't tell you whether ETH leads or lags BTC or not. I think it depends on the time. Back in 2021, I think the alts were leading everything, and then ETH was following, and then Bitcoin was following that, and then it changes from time to time. I wouldn't put too much store on it.
All right, that's a wrap. As always, we went overtime, but at least we went overtime in the questions because we want to try and make sure everyone's questions get answered. If we can, we will. And I think that's it for today. Again, the link pinned to the top of the chat. If you don't have a Deribit account, sign up there, get 10%. Also, you can check out our special offer, roguetrader.academy/special offer. Get $7, 14-day access to our course and to our Telegram channel. As always, with our good friends over at Deribit, this is a fantastic Deribit Live. We will see you next week. We're going to continue the journey on covered calls and start talking about covered call campaigns. So hopefully we will see you next week.
Thanks, guys.